Et, et. Ouais, c'est bon?
And of course, we'll have plenty more on that throughout the day. Now, President Trump saying he would meet with Saudi Arabia and Russia in the goal of staunching this historic oil plunge. We also heard from Russia just moments ago saying that they're not looking, they could meet, but they're not looking to meet with Saudi Arabia. Well, joining us now on the phone is Kevin Book. He is Clearview Energy Partners Head of Research. Kevin, always great to speak to you on the phone. What amount of pain can Russia and Saudi actually have? This is about market share. This comes at a time where already the world is on hiatus, so they're not demanding, they don't want any oil. Is $10 enough, low enough to get Saudi Arabia and Russia talking?
Good morning, and thanks for having me. $10 will focus the mind anywhere in the world. But when you look at the foreign exchange reserves and the tolerances of both countries, I don't think it's entirely an economic proposition. You still have non-economic pressure being brought to bear explicitly on Capitol Hill and maybe more quietly here in Washington at the executive level against Saudi Arabia, and some soft pressure, maybe a little bit firmer pressure from sanctions in Venezuela, sort of hinting at what could happen with regards to Russia. So direct engagement perhaps maybe as much a factor as economic reality. Duration is, ultimately the pressure point for this entire price equation. As inventories build, the longer this goes, the more everybody's going to be focused on a workout in the end.
Who will win in the end? Who will win market share? Who will, come out triumphant?
Well, it's an open question for at the headline level. Is it going to be an OPEC victory? The answer is probably in the near term, yes. You'll see shut-ins around the world from the higher marginal cost producers already starting to happen. But in sort of the intermediate term, as we look at what's happening right now, it's a long skid mark in the shale patch. It takes a while for things to shut in. Things don't shut in immediately. And when things start back up, they can happen pretty fast, too. So victory, I think, probably will be measured mostly at the margins, the higher marginal cost producers inside of the global picture, not so much OPEC versus shale.
Kevin, you and Clearview are wonderfully wired into the Washington energy zeitgeist. Some of us of a certain vintage remember Midland, Texas, of decades and decades ago. And folks, that was an absolute collapse of a local economy. Kevin, how's the Permian Basin going to do here? What do you hear from their political representatives, and what do you hear from the energy industry about the future of Permian Basin at 15 or 20 or $25 a barrel?
Well, you really bring up an important point, Tom, because if you look at the differential in Midland relative to the WTI benchmark in Cushing, Oklahoma, we're looking at it deeply inverted, particularly after it turned out that the Strategic Petroleum Reserve fill did not go through in the last stimulus package. So what they're asking for is a range of options. They're saying, look, this is important as an economic multiplier throughout the economy. Let's look at a range of proposals. Everything, yes, from the SPR fill, still not, by the way, out of the picture as a commercial leasing opportunity, but also looking ahead at whether or not there's some sort of make-whole payment or production credit or direct intervention just to keep operators solvent, just to keep them functioning on a cash basis and to keep jobs intact and prevent bank failures as part of sort of a broader systemic risk. So they're pushing across the board from the industry here in Washington. They're getting some receptivity. You've seen some very vocal senators, but it's more a question, I think, in terms of what the next stimulus fight might look like.
Oh, what the next fight will, what's it going to look like? I mean, what's going to be the energy battle in Pelosi 2?
Well, if you think about what happened last time, time was the principal constraint, Tom. So it ended up on the cutting room floor. It was a fight between green BTUs and fossil energy, and nobody wanted to take the time for the fight. If you go back, however, Tom, if you will, to 2015, when you remember the oil export ban was lifted, that was a big watershed moment in oil policy here, an intervention that was a trade. It was a trade, again, you can measure in BTUs. Oil and gas had to give up a lot, essentially, to get a deal on exporting oil. What they gave up was green energy market share, 5 years of long-term credit extensions. Look for a similar gambit here today. As we look at stage 4, that's I think, what the stakes are going to be measured in, Tom, green BTUs.
Kevin Book, thank you so much for Clearview today, a briefing on oil in Washington. And this again, folks, West Texas Intermediate in the $20 a barrel range. As we brought you Abby Joseph Cohen earlier in this hour, our conversations through the day with true policymakers. We are thrilled to bring you a conversation with Olivier Blanchard of the Peterson Institute. He has written a piercing essay on whatever it takes. Professor Blanchard will join us here in a bit. Stay with us. This is Bloomberg.
I hope that banks will follow, and we have seen other banks following the ECB recommendation this morning. Besides UniCredit, I think it's important for banks to be here to support the economy. Banks are part of the solution.
You're watching Bloomberg Surveillance. I'm Viviana Hurtado. Let's get your Bloomberg Business Flash. We begin with General Electric finalizing the $21.4 billion sale of its biopharma business, and that brings in much-needed cash. It bolsters CEO Larry Culp's efforts to chip away at a massive debt load. GE selling the biopharma unit to Danaher. And the latest blow to Xerox's attempt to stimulate growth. It dropped its hostile takeover bid for HP, the photocopier and printer company, blaming uncertainty stemming from the coronavirus pandemic. HP says the $35 billion offer undervalued the personal computer maker. And that's your Bloomberg Business Flash. Francine, Tom.
Viviana, thank you so much. There are people that have the pulse of modern corporations worldwide, the multinationals, and indeed across this America, people speaking with corporate officers dealing with an original crisis. Sullivan Cromwell is a vested firm. It's been around for ages, distinguished, as they say. And Frank Aquila joins us now, who drives forward so many of their conversations. Frank, let me begin there right now. Simply, what are you and your senior partners hearing when you speak to your clients?
Good morning, Tom. Yeah, the conversation is fairly constant, the proverbial 24/7. What we're hearing is certainly, a focus first and foremost on liquidity. Secondly, looking at what they need to be doing to keep their business moving ahead, to the extent that they need to be doing things to deal with their clients, to deal with their employees, and really looking at all the various aspects. But there's certainly a great deal of foreboding as to what's going to come next year.
What we see right now, Frank, and certainly on this April 1st with rents due, are two Americas. John Edwards, of course, partitioning that eloquently years ago. It seems to be business as usual for corporations, while so many of America, Main Street America, need a direct income substitution right now. How can corporate America explain to Washington the urgency of aid to the people of this nation?
Well, I think corporate America understands it in some ways better than Washington, because they recognize the knock-on effect as people stop paying their landlords, people stop paying other bills, and then that has an impact on the landlords who stop paying their loans, and it puts the banks in a further in a precarious situation. So I think corporate America, in many ways, understands the fragility of the American economy and the weakness of many consumers far better than some of our elected representatives do.
Frank, give me a sense of what deals, M&A in the U.S. that was about to happen or that was already announced. What will happen to it now? Will it be postponed, delayed, or just canceled?
Well, I think deals that were signed and announced by and large are going to continue along, and they will happen. We just heard the news about GE closing their transaction with Danaher. I think most major transactions will continue forward. Certainly the ones that I'm working on between signing and closing are moving apace. They may be a little bit slower to complete just because regulators are working remotely, so it may take a little bit longer to get approvals. Deals that were not announced, I think they fall into three buckets. A third of them, roughly, get put into abeyance and probably don't happen. Another third get put into abeyance and then come back at some point. And then another third we see are moving along slowly. But they will be substituted, the ones that don't happen, will be substituted by deals where, because of the liquidity issues, companies will decide to sell themselves. Companies will decide to sell assets and businesses that are non-core. So, we're going to have a very weak first half in M&A, but at some point in the second half, you're going to see a couple of months or so that are going to be very, very strong as that pipeline really moves forward.
Is there a danger that when we come out of this, the economy kickstarts, if companies are about to fail, they get taken over? So this is the kind of, the bad kind of M&A, the M&A that comes out of desperation.
Right. A lot of what we saw in 2008 and 2009, there's certainly that possibility. I do think that one of the factors with respect to the government stimulus packages around the world is that fewer companies will feel that sort of desperation. That's at least the hope.
All right, thank you so much. He is, of course, Frank Aquila, and he was talking to us from Sullivan and Cromwell. He is global head of M&A. Now, coming up, we have a lot more on central banks. We have a fantastic conversation a little bit later on with Bill Dudley. Also later today, the Qualcomm chief executive joins us. That's at 5 p.m. in New York. That's 10 p.m. in London. And this is Bloomberg.
Yet another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Commodity investing is more than buying gold and oil. From coffee and corn to cattle and natural gas, many sectors drive the commodity markets. And the Bloomberg Commodity Index covers them all. With exposure across 23 traded commodities, Bloomberg is the standard for diversification in commodity markets. With full transparency, measure and monitor your investment performance against the benchmark used by commodity professionals globally. More than gold and oil, the Bloomberg Commodity Index.
Well, good morning, good afternoon, good evening, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Xiaomi, the Chinese phone maker, reported a 27% year-on-year jump in fourth quarter revenue. That beats expectations thanks to robust growth on internet service, but also business overseas. Well, we heard from the company's president. Here he is.
Offline sales in China were affected a bit, and most of Xiaomi stores were closed or operated shortened hours with significantly low customer traffic back to February, early February and late January. But however, we comparatively less impacted due to our advantages in online channels, and we have seen smartphone shipment rebounded quickly in late March 2020, showing the resilience of smartphone demand. So we reopened many stores. Right now, it's 2,000 stores reopened in China. So we see recovery. So right now, the market, the smartphone market specifically, is about maybe 80% to 90% of a normal of January demand. This is what we are seeing. And our manufacturing capacity also recovered close to 90% already.
Curious about the increase that you've also seen in some of the internet services business. How much of a boost was that to you, given the shutdown really of the economy during the coronavirus pandemic?
Yeah, toward internet services, actually user traffic of our content-driven services, for example, the video and online games recorded solid growth as people stay at home. So in the meantime, our advertising business could potentially be impacted if our advertising customers decrease their budget. So that's we have some increases and some decreases, but overall, I think we grow the internet services.
Well, that was the president of Show Me speaking to our Taylor Riggs a little bit earlier on. Now, this is what the picture looks like on your markets. A lot of the focus is, of course, on what President Trump said yesterday, that the economy will probably get kick-started later than expected, and actually the number of horrific deaths that he was talking about. So the markets are taking a bit of a pause. We certainly saw a lot of pressure on European stocks. American equity futures also falling with these stocks in Europe as investors take worsening U.S. coronavirus figures badly and also assess the pandemic's impact on corporate profits and dividends. I'm looking at dollar climbing, yen also catching a bid. Speaking of dividends, a lot of companies here in the UK, certainly a lot of banks, halted dividends at the request of the Bank of England. I'm looking at HSBC, Standard Chartered, Royal Bank of Scotland, but also Barclays and Lloyds Banking Group, all cancelling their outstanding dividends and buybacks and said there would be no payments in 2020. So you can see stocks under pressure after that announcement, and it comes after the Bank of England's PRA wrote to lenders on Tuesday asking them to cancel these dividend payments while calling attention to their role in supporting the wider economy. Well, tomorrow, an important conversation, an exclusive conversation with Bill Winters on this very subject. He's chief executive of Standard Chartered. This is Bloomberg.
Fuel, corn, livestock, precious metals. Commodities are everywhere, and so is Bloomberg. Bloomberg commodity indices deliver leading benchmarks for true diversification. Adding commodity exposure can help hedge against inflation and diversify your stock and bond portfolios. With full data transparency and broad distribution, the Bloomberg suite of commodity indices is your measure for the commodity markets. With Bloomberg, you've got the markets covered. True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
PMI pummeled. Manufacturing activity shrinks fast all across the world. From South Korea to Indonesia to Italy, as the second quarter kicks off with a thud. A hell of a bad 2 weeks. President Trump gives his bleakest assessments of the virus outbreak in the U.S. as deaths climb in New York City. And regulators come now after dividends. UK firms like HSBC to scrap dividends and cash payouts. HSBC already said it would cancel an interim dividend. Welcome to Bloomberg Daybreak on this Wednesday, April 1st. I'm Alex Steele. It looks like we're opening up to be a very difficult news cycle today and a very difficult market open today as well. You're looking at S&P futures down by about 3 percentage points right around the lows of the session. Yeah, you had weak PMI coming out all across Asia as well as in Europe, but really it's just the overall negativity of just how bad maybe things can get, particularly here in the U.S. It's pushing a lot of pressure on equities. The solution to that is go ahead and buy bonds. We're seeing the bond yield here in the U.S. at 60 basis points in the 10-year, sort of trending really close now, 6 bips away from that record low. And the dollar, obviously the safe haven of choice in the G10 space, and oil getting a bit of a reprieve if you have Russia not pumping more. The concern is that you'd have even more oil flood the market today. The OPEC Plus deal comes to a final end. So we want to dig a little deeper here for today's market moving news from New York as well as Washington. We're going to start off with the latest PMI data. As I mentioned, factories around the world suffering one of their grimmest months on record in March as the pandemic led to mass shutdowns and wreaked some havoc on supply chains. Bloomberg's Michael McKee, Bloomberg Chief International Economics and Policy Correspondent, joins me for more. Mike, there's a lot to dig into. Give me some of your takeaways here.
Well, Alex, Mr. Rogers' word of the day is contraction. The Purchasing Managers Index is the first look at economies around the world for a month, and across the developed world, they are pretty bleak at this point, although some of them not as bad as thought because of a quirk in the data. But let's go through the data right now. Italy, you showed that chart, hardest hit of anybody by the virus, and now the hardest hit in terms of the PMI numbers. Also, Spain, France, Germany, the Eurozone, UK, they're also in the 40s, which marks contraction, of course, anything below 50. New orders and production crash, but there is this quirk in the data where supplier delivery times, if they lengthen, that's supposed to be good because business is good. However, in this case, there's no supplies to deliver, so it makes the numbers artificially high. Imagine what they would be without that. China adding that on the bottom, the Caixin, which is more medium-sized companies, more foreign dealings, they're up to 50. But remember, this index compares how you're doing this month with last month. So by definition, they're doing a little better. Doesn't mean there's a major recovery going on in China. I do have, and I don't know if we have the chart because of the difficulties that everybody's having these days, but I want to show you, if we got it, an interesting chart from Germany. Retail sales last month exploded, not because the economy is doing really well, but look at that line on the right, because everybody was stocking up ahead of the virus and ahead of being pinned in their homes. And that's what we're going to see in a couple of weeks when we report retail sales for the month. We'll see, especially in the grocery section, that kind of number. German Chancellor Angela Merkel, meanwhile, is beginning to talk about a joint financing plan with the rest of Europe. This is a major breakthrough if she goes ahead with it, issuing euro bonds to try to help all the countries there. They've been strongly against that. And she's also signaling that she is considering getting rid of the Schwarzenegger, the constitutional provision that prevents them from unlimited borrowing. This would allow them to sell a lot of bonds and try to put money into their economy. One other note from Europe, the French finance minister, Bruno Le Maire, saying that they may nationalize companies in order to save them, put so much money in that they take control of those companies. And Alex, ahead for us today, we get our own purchasing managers numbers. The ISM out this morning expected to dip into the 40s, and we get that ADP employment number, which could be interesting because they measure the whole month rather than just a month at the week at the beginning of the month, like the payrolls report on Friday. Still, only about 150,000 jobs lost is the forecast for that. Those numbers not catching up to where we are right now.
All right, Mike, super appreciate it. A great analysis and lay of the land for today. Bloomberg's Michael McKee. I want to turn to general markets here, starting on oil. Crude holding nearly $20 a barrel. Saudi Arabia's output's going to climb about 12 million barrels of oil a day as the OPEC Plus deal comes offline. But Russia may not be pumping more. Bloomberg's Emery Horton's here with more. Hey, Emery.
Good morning, Alex. Yeah, that's right. It's April 1st. So the OPEC Plus deal that they struck in 2016, that historic deal, that is now shelved and they can pump at will. Saudi seems to be doing that, but Russia's saying they won't just yet. And the data we have for March so far shows that actually Russia production has been relatively flat. Tomorrow we'll get the full picture. And even though this comes as Alexander Novak, the energy minister, said that they were capable of doing so just weeks ago. And the price war, it's still abating. BP, look at that, down more than 1%. They're joining a number of companies that are just adjusting to this new normal. They cut CapEx by 25%, and they made no mention of its generous dividends. So really, we're seeing all these big oil majors come out and do that. Moving on to what else we're seeing in the markets, we have closed out the first quarter, the worst one since 2008. The S&P 500 closed down yesterday exactly 20%. And futures this morning are looking at a serious downdraft at the open. S&P futures down more than 3%. In Europe, the Stoxx 600 is down more than 3%. All the major indices are in the red. HSBC and a number of banks like Standard Chartered under pressure, urged by regulators in the UK, the British regulators. They decided to halt dividends and share buybacks. That stock is down more than 8%. And Treasury's up this morning with the yield ticking 0.61%. Alex, if you were looking for this morning to see if that worst quarter since 2008 is now behind us, potentially some optimism, I don't think so just yet.
No, definitely not. Not as the news flow continues to get so negative. All right, Bloomberg's Anne-Marie Horton, thank you very much. I want to continue on a theme that Anne-Marie just picked up on, and that's the virus fallout on financials. So she was talking about shares of British banks really tumbling, lenders overall scrapping their dividends and buybacks. They're also halting major bonuses for some key staff. At the urging all of regulators, the banks are trying to bolster their capital levels against the fallout from the coronavirus outbreak. So to pivot off of that, Barclays now predicting that European earnings and dividends should now fall by about 40% this year. The bank says the economic impact from the coronavirus will be as severe as a Great Recession. They do still say it won't last long, but we will have to recalibrate in a world where maybe buybacks aren't as prevalent, and neither are dividends. And has that reflect your value for the S&P? We'll break that down over the next couple hours. Coming up right now on this program, though, more of your morning's news, top trades, and analysis on the markets in today's First Take. This is Bloomberg. Time now for Bloomberg First Take. We give you the news, you get the trade, the analysis of the markets. Joining me from our in-house team of Wall Street veterans and insiders, Damian Sassower, Bloomberg Intelligence Chief Emerging Market Credit Strategist, and Michael McKee, Bloomberg International Economics and Policy Correspondent. All right, Damian, so we open the day here. We're, April 1st, we're the start of the second quarter here. What are you looking at? What do you think is the overwhelming theme that's going to be here?
Yeah, I'm looking at lumber prices. Lumber prices are the lowest since December 2015. Emerging markets need dollars. There's $5 trillion of U.S. Treasuries on deposit at the Fed, which means paper is cheap. I'm just kidding. But really, we had some stimulus out of the Fed yesterday trying to deal with this issue. Clearly, the market's not reacting positively to it because there's red all over the screens across EMFX. And foreign central banks that can post Treasuries for dollars, it may very well address short-term liquidity stress, but there are some risks there, and it certainly seems to be prohibitively expensive at current levels.
Well, so, Mike, does that mean that what the Fed did yesterday is not working, or does it just mean that now the liquidity issues are taking a backseat to other problems?
Well, they're not really taking a back seat. It just takes time for all this to work its way into the markets. The announcement yesterday that they're going to do repos really gives a lifeline to some of the emerging market countries because it makes them eligible to get dollars from the Fed in ways that they aren't with because they're not included in the swap lines. They're really short term, and that money has to be repaid, and there's a penalty rate. So it isn't the easiest funding in the world, but it is there if they need it, and we'll have to see if there's a lot of take-up on it going forward. There has been a significant take-up in terms of the swap lines, so money is getting out there. And in the bigger developed economies, we're seeing a lot less dollar stress funding. The one market where you're still seeing some stress is commercial paper. The Fed announced its program, but it hasn't put it into effect yet. They're still standing it up. It could take another week or so. So we're going to see some stresses there. In general, stress is down in the markets, but it is still in pockets.
So then, Damian, to pivot off of that, if we were to see sort of these extended repos really work, what would be the rate that we would have to see? Like, what do you think that emerging markets really need right now?
Yeah, no, I mean, great question. I mean, really what we're seeing here is 25 bips over the interest on excess reserve. So it's about 35 percentage points, really, which is what, banks would be having to pay. I'm sorry, central banks offshore would have to pay for, borrowing off their U.S. Treasury collateral. But look, I think for me, all that aside, it's really going to be a function of, if you just look at the knock-on impact to the front ends of a lot of these curves, I'm going to use China for one example. Forward points out to the 5-month tenor in China have turned negative, which means you get paid to hedge against dollar upside. I mean, that should never happen. If you look at the dollar-yen cross-currency basis, one of the big three that we always look at, it's been negative forever. It turned positive overnight, okay? So to Mike's point, what you're seeing is, yes, obviously a lot of the liquidity stresses, we're doing everything we can to address these. Clearly the commercial paper issue is still a problem there. But, for me, these create dislocations in the market that need to be taken advantage of. You should not be paid for the privilege of hedging against dollar upside in my mind. And so, when the market gives you that, you got to take advantage of it.
How?
Well, you basically hedge you basically hedge against dollar upside and dollar yuan. I mean, look, we're at 709, I think, in dollar yuan right now. But the fact that hedging out to 5 months, 6 months, you get paid to basically protect against dollar upside while carrying in positively yielding China government bonds. That's one way to kind of extract the yield over treasuries. So these are the kind of opportunities if you're a carry-minded investor and you're not, and you're looking for yield pickup. These are the kind of tools that you can take advantage of.
At the same time, we had Jeff Gunlock on Double Line. Mike had a podcast to sort of he talks to his investors yesterday. He said the U.S. is likely to follow companies like Europe, Japan, and emerging market economies that basically have not seen their high in their markets for about more than a decade. Is that going to be the sort of stagnation conversation among economists as we come out of this, or forget a letter recovery?
Yeah, a lot of people are beginning to feel that way. When they look at the trajectory of all this, they're saying what we see is a very fast drop. We're going to see a big drop in global output in the month of April and in the first and second quarters. But then how fast we get back is hard to tell because we don't know how long this disease will go on. But at the same time, what are people going to want to buy? Do they want to go out immediately to restaurants, or are they still going to be nervous? Is there going to be a psychology that we want to sit back and save rather than go out and spend because we don't know if this could happen again? So we could see an extended recovery. And if that demand isn't there, it's certainly going to hurt a lot of companies. I'm thinking of Macy's, which furloughed all its employees this week. Are people going to really go out and buy a lot of clothes, do a lot of shopping immediately? Or is it going to take time for them to see any kind of business recovery? This could lead to a lot of restructuring in different industries like retail. And I wanted to point out, we were talking about the stimulus programs and how they're working in various areas. Companies like Macy's aren't going to be able to get loans probably from the Federal Reserve. Maybe the Treasury Secretary will make an exception for them, but anybody who has junk-rated paper isn't eligible right now. So you could see some big companies in some big trouble who cannot get the emergency loans that others are.
Well, it's a good point. We've also seen lots of other issues, say with REITs, for example. We talked about this yesterday. Mortgage bankers worried about certain dislocations in the market as well. Some freezing any sort of redemptions because they don't want to sell corporate loans into this market. Leveraged loans, CLOs, all that coming a problem. What's the Fed thinking about all of that?
Well, they're obviously watching for what's going to happen and whether they can intervene or not. And there's a debate about how far you go down the credit ladder in order to help people. Bill Dudley out with an op-ed on Bloomberg today suggesting you don't want to really get involved with leveraged loans and CLOs and junk-rated companies because that was investors taking a risk for a bigger return, and now their risk is blowing up. And that's what happens in markets, and they shouldn't be bailed out because then the government is taking on enormous credit risk. So that's going to be a debate going forward. I think the Fed legally has to be on the side of not doing it, and they probably won't be going to Congress to ask for an exception at this point.
All right, fair point. Damien, I want to sort of end with you here because we did get a slew of PMIs. Mike was talking about that before coming out. The Caixin in China, which is small and medium-sized businesses, actually holding up, obviously. But then you had South Korea, Indonesia, Europe, Italy, terrible. I mean, the worst since like 2009. What did you learn through those numbers?
I honestly, I have to say, I really haven't even put any emphasis whatsoever on the economic data which is coming out because it's going to be bad, it's going to be worse, it's going to get worse. I mean, we're still in the middle of this. So, really the data, isn't really, for me, driving the market pricing. For me, it's about the quantity of money, right? I mean, you look at the Fed balance sheet. It jumped to $5.3 trillion from $4.22 trillion at the end of February, I mean, the amount of stimulus and the size of the Fed balance sheet and the speed at which it's expanding is really just overwhelming any sort of fundamental data inputs that you might, hope to lean on in this time. And look, I mean, equities, the first ones to rally. We've seen spreads come in. I'm talking U.S. IG, U.S. high yield quite considerably. I mean, U.S. high yield spreads have fallen 220 bips since the end of March. I mean, in U.S. IG, we're now back down to 272 bips. They fell 100 bips since March 23rd. Remember, these spreads were down below 100 basis points in IG in mid-January, So, some of these moves, the volatility you're seeing is a little bit of liquidity returning to some of these illiquid credit markets. But at the end of the day, emerging market spreads have really not come off the way their counterparts here in the U.S. have, which really points to the stresses that we're seeing offshore. And that's really where my focus is, Alex.
You just killed Mike McKee, not looking at the eco reports. But when you talk about, just to pivot off of that, just to round it out, Damien, is this conversation, when all this is said and done, are we going to be talking about the dollar not being the only world reserve currency because of what this crisis showed us?
Oh, God. I mean, that's a very difficult call to make. No, I think structurally we've now been in 6, 7, call it 8 generations of people who are conditioned to use the dollar as their fiat currency du jour. I mean, I know a lot of emerging market investors, located offshore, they struggle to get their hands on dollars. They've been conditioned to denominate in dollars. Dollars are still, the role of the dollar is not changing tomorrow. That, goes without saying that, we could see a hyperinflationary spike of some of these measures, which could certainly devalue it. But for me, I just see the dollar as being structurally, the linchpin to the global emerging market, and it's not going to change anytime soon, Alex.
All right, guys, I really appreciate your time today. That's Bloomberg Michael McKee, international economics and policy correspondent, and Damien Sasser, Bloomberg Intelligence. Always good to catch up with you as well. And a reminder, any charts we're using throughout the show, you just go right to GTV Go on your terminal. You can browse all the features there and check it out. This is Bloomberg.
Hurtado with your Bloomberg Business Flash. We begin with the latest blow to Xerox's attempt to stimulate growth. It dropped its hostile takeover bid for HP, the photocopier and printer company, blaming uncertainty stemming from the coronavirus pandemic. HP says the $35 billion offer undervalued the personal computer maker. Now to General Electric finalizing the $21.4 billion sale of its biopharma business, and that brings in much needed cash. It also bolsters CEO Larry Culp's efforts to chip away at a massive debt load. GE sold the biopharma unit to Danaher. And we end with investors piling into exchange-traded funds that track gold. On Monday, BlackRock's iShares Gold Trust attracting $332 million. That's its biggest inflow since 2011. Last week, State Street's SPDR Gold Shares Fund taking in almost $2.9 billion. That's the most since 2009. And that's your Bloomberg Business Flash. Alex.
Thanks so much, Viviana. Joining me now is Sylvia Jablonski, Managing Director of Capital Markets and Institutional ETF Strategies. If you want to know where flows are going, Sylvia is the person to talk to. Sylvia, give us some insight as to what's moving, what's not, how we're set up for the second quarter.
Hi, Alex. Good morning. So there are definitely some corona economics in the markets, and I think, when we take a step back and look at the markets, we see valuations globally looking fairly attractive and pretty low. You can't call the bottom, but if you have a long-term time horizon, there are some bright spots out there. Some of the flows that we've seen recently have been into places like healthcare, ETFs that track healthcare companies and biotech companies, which, could come up with potentially a cure or a vaccine or, essentially something that will abate the coronavirus. They're flush with cash. They have strong balance sheets, and, it's sort of been a late cycle performer anyway prior to coronavirus. So there are some challenges in the near future, but there could be some bright spots as we see, what sort of comes out from that sector as it relates to the virus. Some other areas that we've seen interest in have been both consumer staples and consumer discretionary. So, if you look at the recent shakeup of the select sector indices, if you look at staples, some of the top names in there are things like, Procter & Gamble, you've got Costco, you've got, some of these big bulge bracket stores that sell things like toilet paper. And, what are people buying? They're going out and buying a whole bunch of things like toilet paper, tissues, Coca-Cola. So all of those names remain, heavy and strong. On the other side of consumer discretionary is Amazon. Now, consumer discretionary is something that you want more than something that you need in theory. But if you look at the names in the index, Amazon being the top name there, what does Amazon sell? You've got everything from live streaming, people sitting at home watching TV, buying movies. You've got the consumer staples in there. A lot of people are buying paper towels and toilet paper at Amazon too. And I think that, they keep coming out and saying that they're hiring hundreds and thousands of workers. So obviously the demand is there, and we've seen the two flows. Viviana just mentioned it, that they've seen, the market has seen a lot of flow into gold-related ETFs. We've seen the same on our side. So gold miners and flight to safety types of plays like flow into utilities, bonds, and gold-related ETFs. So, I think investors, particularly with shorter horizons, are looking for the short-term tactical opportunities that are moving the market, which again are like staples, discretionary, gold, and longer term they're looking for, low valuations and entry points across all sorts of sectors like tech and semi that'll probably continue to do well into the future.
So, Sylvia, with about a minute left, can you tell me about sort of the ETNs, the leverage guys, like which ones are wiped out?
So they're not, we don't have, ETFs that are wiped out, but in terms of, coming off of highs, I mean, the names that brought us up into the tops of the S&P 500 are the names that have been, really hit the most. I'll start with really oil and energy, because those have been, those have definitely seen a downturn, with 2020 being one of the worst year for oil since, in decades. Basically, it's fallen 70% and quickly approaching, if it's not there, at $20. But also, tech and semi in the short term, just because all the stores are closed, they're high beta names, and so look to those also though at low valuations for potential recovery when we get past this.
Well, All right, Sylvie, hang tight. We're going to talk more about oil. Sylvie Jablonski of Direction will be sticking with us. Coming up, President Trump says the U.S. would meet with Russia and Saudi Arabia to discuss the oil markets. More with Francisco Blanche of Bank of America. This is Bloomberg.
Melinda Gates, thank you so much for joining us on Bloomberg Studio 1.0.
Who shaped my views were the women I talked to.
I think Facebook's how we won in a lot of ways.
Running Microsoft was a ton of fun, and it was, it's kind of inspirational.
This is your weekly review of the most important business news and interviews from Bloomberg Television around the world.
Even in a circumstance where you're down 80% of the rest of the year, we're still going to have $4 billion of cash. We're going to have access to a $2 billion revolver. We think it's highly